Hi, everyone. My name is Peter Mitchell, Managing Partner at Kingsgate Capital Partners, and welcome to Five by the Fire. These short, sharp podcasts are designed by investors for investors of capital to provide a deeper understanding of the managers we represent and the strategies they manage. In this episode, we have Andrew Johnston from our advisory board, who provides expert investment and asset consulting services to family offices, asking Matt McNamara, CIO of Horizon Healthcare, 5 questions about their highly regarded Horizon 3 U.S. Healthcare Trust. I'll now hand it over to Andrew to lead the discussion, so let's get into it.
All right. Thank you, Pete, and welcome, Matt. Thank you very much for your time and sharing your insights with us today. Thank you. We'll probably launch straight into it. I've got a bunch of questions here, which is a little bit based on some of the stuff I've read, and a little bit of the conversations we've had in the past. So just starting off pretty broad with the strategy. You've had a number of VC and early stage investment mandates in your past. Why the switch to later stage in this one?
Well, as all investors know, risk equals return. The very first fund I managed was a pre-seed fund. Too much risk, very little return, because the probability of any return was very low. So we've decided to go later, where there is a greater probability of getting a return for some of the portfolio companies. So our investment strategy is it's got to tick a lot of boxes. It's got to be novel, and it's got to be I can source globally, private, so we're not doing public. The portfolio company needs to be able to only have 1 or 2 major milestones to achieve to being attractive to an acquisition target. So that's really key, and that talks to our exit strategy. The portfolio company, the prospective portfolio company, needs to have the potential to be able to return a 1x per annum. And given we're only a 5-year fund, that lends to being a later stage investor. We will typically only be in each investment for 3 to 4 years. So we're not being greedy we're a late stage VC, and an early stage VC will look for 20 baggers. We're looking for a 3 to 4 bagger. And in a portfolio of 8 to 10, my track record, our expectation is that 3 to 4 out of those 8 to 10 portfolio companies will deliver on that strategy, and that will then deliver a greater than 20% IRR to our LPs.
Okay. You mentioned novel in what you've just said then, and also throughout the marketing materials. Can you just elaborate on what that definition actually means specifically to this investment universe? I think maybe we might use it in a more sort of generalist English way, but it actually has a very specific meaning in your world, doesn't it?
Yes and no. It does mean what it means in lay person's terms, but I'll explain it in our terms. We see over 300 companies per annum, and we can't afford to fall in love with all 300 because we can't do full due diligence on all those 300. So pharma and medtech companies, I've talked about our exit strategy. I've talked about, being an attractive acquisition target. They're not interested in incremental improvements. Okay. They don't want the next beta blocker. They don't want, the one that's going to give a 1% improvement on hypertension control or hypercholesterolemia. They want new, more effective ways to improve people's lives. So you'll see if I get to talk about some portfolio companies, you'll see that it's a completely different way of tackling things. Or, I'll use one that I won't talk about later, but for instance, implants. So there's a lot of implants. We have implants in our jaws, implants in our knees, hips, shoulders, and all that. They are basically inert. Another company we're involved in actually recognized that and said, that's fine, it's doing an okay job, but there is no information coming back to the surgeon or the patient. What if we put smart sensors in these implants, and they could actually talk to us for years and years to come. So, that it's a real paradigm shift. And the couple of examples I can give you later, if you're interested, will show just how novel these technologies are and why we get excited by them. And clearly they need to have IP that protects them and that there aren't quick people following on.
Okay, so being able to identify those companies, in particular the ones that are attractive for an acquisition, very important in anything that in late stage or early stage VC are those origination channels. So how does your team make sure that you're seeing something that someone else isn't, make sure that you're finding something original? And how do you do that with a reasonably small fund base to make sure that you've got the expertise to look at multiple things?
Yeah, look, the very first thing you just mentioned then was so that we see it and others don't. We cannot ensure that, and we don't need to ensure that because we are a small fund. You touched on that. And so we will be a part of a syndicate because these are later stage companies that are investing, that are doing large capital raises. But coming back to the crux of your question, your audience can't see, but I've got grey hair, and most of the team have got grey hair, and I'm really proud of that because I've seen a lot of successes and a lot of failures, and that gives you experience and experience and networks. So it's our team's networks. We've got a team of about 6 professionals that have done this for over 20 years. I'm up to 40 years in the industry. Coming from a scientist, coming from pharma, and then last 25 years as VC. But having that network ensures we have strong deal flow. Yes, it's not always unique to us. We're often, in the data room with other people. We're attending key global meetings like JP Morgan every January in San Francisco, and the bio meetings in Europe and US, and sourcing friendly referrals because it often helps if you know someone on the board or you've dealt with that management team before and you've got a track record from them. Our due diligence process quickly identifies weaknesses that do not fit with our investment strategy. So that's how we weed it out very, very quickly. So of those 300, we typically only invest in 1% of what we see, which is fine. Three or 4 a year is good investment deal flow for us. Okay. Our $5 million US ticket size is never going to lead around, but certainly gives us a seat at the table and often at the board.
Thank you. That's interesting, even as a slightly different approach. In terms of you don't have to have control, you don't have to exert that. That's probably makes more sense from a fund in Australia reaching out to things in Europe and US as well.
Absolutely.
One of the things I was lucky enough to have lunch with yourself and Mike about 6 months ago. There are a couple of very, very interesting companies in the portfolio. So maybe a chance to delve into some of those. A few of those were approaching possibly some updates or possibly one of those catalysts. Have any of those occurred? Did you want to share maybe some deeper insight into any of the companies?
Interesting you should say that. Just last week we had a company called Lumathera, which uses infrared and near-infrared light through the eyeball to treat dry age-related macular degeneration, which is the largest cause of blindness in older people over 55. They already had EU approval. They now have FDA approval. So their risk now is a sales and marketing risk, exercise, execution. And because they've been selling in the EU, they've already learnt a lot. So, that is a greatly de-risked company. And the competition is needles in the eye. So I don't know which you prefer, some light shining on your eye or some needles in your eye. They've got a strategic on the register and so are expecting to be taken out in the next 1 or 2 years. The other company is Cardiac Dimensions, and this is another example of novel technology. Most people for heart failure, where there's a problem with the mitral valve, are looking at trying to interfere with the the valves within the valve, the door frame, the doors, if you like. These guys actually put in what I call a cross between a paperclip and a stent in through the jugular, which I know sounds awful to us lay people, but for a medico that's called non-invasive, and it finds its way to the outside of the mitral valve, which there just so happens to be the coronary sinus vein running around 180% of this mitral valve, and they can put this curly paperclip stent in and cinch it and close up the door frame of the valve without actually touching the valve, and it stays there permanently. They also have a strategic on their register, and they're likely to acquire them once this trial finishes within 2 years.
Oh, thank you, Matt. Thank you for that really detailed insight into the portfolio. What I find really impressive about the portfolio and those companies is they're a very specific use case, which means it's very easy or easier to identify exactly what the market's going to be. And then it seems to have, once you get through those FDA or through the approval process, a clearer path to how you're going to market and monetize. So thank you very much for that. For our listeners, if you want to find out more about the Horizon 3 US Healthcare Trust, please get in contact with Kingsgate Capital Partners team or head to the website. Thank you everyone for your time, and thank you for listening to Five by the Fire.